Hello fellow compounders, welcome back. Do you own a dividend portfolio? Have you ever wondered how to increase its yield without doing much work? In this video, I'll tell you my secret. I'll show you how I earned over $1,000 of extra income by boosting the yield of the portfolio from 5.6% to 8%. This was done with very little effort, without changing the investments in the portfolio, and without taking any additional downside risk. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you are responsible for your own financial decisions. First, let's review my standard dividend portfolio before the enhancement. All information is as of June 8, 2023. I have 5 stocks in my portfolio. Altria, ticker symbol MO, AT&T, ticker symbol T, Bank of America, ticker symbol BAC, ExxonMobil, ticker symbol XOM, and Simon Property Group, ticker symbol SPG. If you bought my portfolio today, June 8, 2023, at the same time I'm filming this episode, you will be investing $4,362 and would expect $2,675 in dividends over the next year. That is a respectable 5.6% dividend yield. Now, when we do the enhancement by adding a covered call strategy to the portfolio, you would get around $1,118 in premium, which is about a 2.5% additional income. In total, you will receive $3,793 in income from the portfolio, which is an 8% income yield. By the way, if you don't know what a covered call is, watch my previous video. Here's the link. Let me summarize the strategy. A covered call is an option that we sell against stock that we own. We collect a premium for the call that we sold, and we give the buyer of the call the option to buy the stock that we owned at an agreed upon price that we call the strike price. And he can buy it at any time before the option expires. A call option contract is for 100 shares. So when we see the price of a call quoted at $2 per share, when we sell a call, we are actually going to collect $200 because it's $2 times 100 shares. Remember, one option contract is for 100 shares. So we are going to sell covered calls against all the stocks in my dividend portfolio and collect premium. Think of it as selling insurance that might or might not be collected on. So let's review the individual numbers. Altria is trading at $45.10 per share and is expected to pay out $3.76 per share in dividends over the next 12 months. That is an 8.3% dividend yield. We own in this portfolio 200 shares with a value of $9,020. The expected dividend for those 200 shares for this the following year is $752. We can sell 2 calls against the Altria shares. That means 2 calls represents 200 shares. We're going to do a strike price of $50 and an expiration date in 379 days. That is June 21st, 2024. That's the expiration date. And we'll collect 92 cents per share or $92 per call. Since we have 2 calls, that's $184 in premium, which represents a 2% income yield over the $9,020. So this means that if Altria doesn't trade above $50 between now and expiration, we get to keep the premium and the $752 in dividends, which is equivalent to a 10.4% income yield on the Altria stock. If the call gets exercised, that means that we would have to sell the shares at $50 per share. We will actually get a capital gain of $980 since we bought the shares for $45.10 and we're selling it for $50. And we also get to keep the $184 in premiums. Next, we have AT&T. AT&T is trading at $15.93 per share, and it's expected to pay out $1.11 in dividends over the next 12 months. That's a 7% dividend yield. We own 500 shares. That means that we can sell 5 covered calls against it, and we'll do it at a strike price of $20 with an expiration in 379 days, the same as Altria. It will expire in June 21st, 2024. And we'll collect 33 cents per covered call. That means times 5 covered calls, that's $165 in premium. This represents a 2.1% income over the $7,965 value of the shares. This means that is if AT&T trades doesn't trade above $20 between now and expiration, we get to keep the $165 of premium plus the dividends of $555 that was produced over the 12 months, giving it a total of $720 of income, which is a 9% yield. If the shares of AT&T were to be called or to be assigned, that means it traded above the $20 strike price, we would make $2,035, which is a 26% capital gain. In addition, we still keep our $165 premium of the covered calls. Okay, so next, let's go down to Bank of America. Bank of America is trading at $29.04, and it's expected to pay an 88 cents per share in dividends over the next 12 months. That's a 3% dividend yield. We own 300 shares, a value worth $8,712, and we're going to sell covered calls, 3 calls at a strike price of 37 for 75 cents per call. That means that we'll get $225 in premium for selling those calls. That is equivalent of a 2.6% income yield. When we add both the income yield of $225 plus the dividend yield of $264, we'll get a total of $489 in income, which represents a 5.6% income yield over the $8,712. That's what the 300 shares are worth. So that's a 5.6% income yield on Bank of America. Same exercise, if our stock were to be called, the options are assigned, then we would actually get a $2,388 in capital gains, and we get to keep our premium, but we lose the shares. Next, we have ExxonMobil. ExxonMobil is trading at $108 per share and is expected to pay $3.64 per share over the next 12 months, a dividend yield of 3.4%. We have 100 shares, so we'll sell 1 call with a strike price of $140. That will expire in 379 days on June 21st, 2024. And we'll collect $2.54 per share. That is $254 in premiums. That represents a 2.4% income on the value of the shares. That means that if ExxonMobil doesn't trade above $140 between now and expiration, we would have collected $364 in dividend plus the $254 in premiums, making it a total of $618 of income, which is a 5.7% income over the $10,800 value of the ExxonMobil stock that we own. And if the stock were to be assigned at $140, that means that we had to sell it at $140, we would make a 30% capital gain of $3,200. Now, finally, Simon Property Group. Simon Property Group is priced at $108 per share, $108.65 per share, and it has a forward dividend yield or a forward dividend rate of $7.40. That means we're expecting dividends of $7.40 over the next 12 months. That is a 6.8% dividend yield, and we own 100 shares. That means that our portfolio has $10,865 worth of Simon Property, and we're going to sell 1 call with a premium of $2.90 per share. That means that we're getting $290 in premium, and same expiration as the previous ones, and that means that the $290 is a 2.7% income yield over the $10,865 that the 100 shares are worth. So the total income that we'll get from Simon Property would be the dividend of $740 plus the premium of $290, which is $1,030, a 9.5% income yield. If we had to give up our stock and sell it at $135, which was a strike price, we would get 24% capital gains, or $2,635. So as I said initially, in total, the entire portfolio that has a value of $47,362 with a dividend projection of $2,675, we're adding an extra $1,118 in income that comes from selling covered calls against the portfolio. And we have no extra downside risk, because if we sold calls or didn't sell calls our downside risk is the same because we own the stock already. What we're giving up is we're giving up part of the upside. So we're capping our upside at the strike prices of each of the stocks. So the maximum capital gain that we can get, if let's say the market just zooms up a whole bunch, so the maximum we'll get is $11,238 for the portfolio because we had capped our upside in exchange for $1,118 of income now. So the trade-off is we give up some upside for income now. So there you have it. With a small addition of the covered call strategy to my dividend income portfolio, we gained $1,118 of extra income from selling the calls, and we increased the income yield of the portfolio from 5.6% to 8%. If you have any questions, please post them in the comments below. Thanks for watching. See you in the next video. Oh, and remember, always be compounding.